Hello, thank you for tuning in. This is Erik Thompson, President and Lead Financial Advisor at Peerless Wealth, LLC, a registered investment advisory firm located in Columbus, Ohio. For this quarterly video, I'd like to address some of the most common questions I've been getting as of late from my clients, from my friends, from my family. And I continue to believe that one of my most valuable roles as a financial advisor is to keep my clients from thinking in terms of extremes, because that can be damaging. So let's get right into it. The first question is, should I prepare myself for higher taxes? Now that Biden is leading our country, there is talk of increased taxes. The short answer, in my opinion, is most people will not pay higher taxes. However, I do believe that the highest income tax bracket will go back up. So right now, the highest federal income tax bracket is 37%. And to pay 37% in taxes, you have to make over roughly $600,000 a year, and that's for joint filers. If you're a single filer, it's closer to $500,000 a year. That bracket was at 39.6% under the Obama administration. Trump reduced it to 37%. I expect that to go back up probably to somewhere close to 39.6 under the Biden administration, probably not till next year. The lower tax brackets, I don't expect much change. He is targeting the high end. High to medium tax brackets, maybe $300,000-$400,000 and up, maybe a slight increase. But I would say $300,000 and less. I personally don't think they're going to change materially. So most people won't be affected by it. The other thing I do see happening is the corporate tax rate is going to increase. Under the Trump administration, Trump reduced it from 28% to 21%. This is what big companies like Apple and AT&T, et cetera, this is the rate they pay on their taxes. He reduced it from 28 to 21. I do expect that to go back up too. Maybe not all the way to 28, but probably mid-20s would be fair. So that is definitely my opinion on tax rates. We are in tax season right now, so many of you have either done your taxes or you're getting pretty close to doing your taxes. The other thing I'll say about taxes is that from a strategy standpoint, if you're saving for retirement, I'm a firm believer that you have money in both regular IRA accounts that are deductible as you put money in, or 401ks, and taxed when withdrawn, but also Roth IRA or Roth 401k accounts. You don't get the deduction now, but it's all tax-free at the end. So if we fast forward to retirement and a hypothetical investor has half their money that's in Roth and half their money that's regular, they have an amazing amount of what I call tax diversification or tax flexibility, in that if tax rates are high, they can just withdraw their retirement income from the Roth account, not pay any taxes. If tax rates are, favorable or reasonable, they can, take out of their regular and pay some taxes. So there's a lot of tax flexibility. If you have everything in taxable, then you're really kind of prone to the risk of higher tax rates in the future. So also on taxes, I practice tax efficient investing in non-retirement accounts that are subject to 1099, write off losses, invest in things that don't create a lot of extra capital gains. So I definitely take taxes into consideration when I'm planning people's retirement and their portfolios. Okay, next question I've been fielding a lot is, should I invest in Bitcoin? And Bitcoin is a type of cryptocurrency, or I like to say digital currency. I think it's very early still to have this as a kind of a mainstream part of somebody's portfolio. I think there's a lot to be said for the benefits of digital currencies. The technology behind them, called blockchain technology, has applications way beyond digital currency world into all sorts of other applications that can make companies a lot more efficient and can reduce their costs, as does a lot of technology. However, there's a lot of hype around it right now, and there's a lot of sort of herd mentality. And that makes me a little bit nervous. It's very difficult to value something like Bitcoin. It doesn't have earnings, it doesn't have a dividend, it doesn't have revenue. So it's very difficult to know what it's worth. And now it has performed amazingly. I think it went from something like $500 a coin back 5 years ago to 50,000 today. So there's been an amazing amount of interest in it. There are now over 1,600 digital currencies out there. So I think a lot of these will just kind of go by the wayside, very similar to the dot-com bubble back in the late 90s, early 2000s. So even though I'm a firm believer in the technology and I'm a believer that digital currency is here to stay, that doesn't necessarily make me believe that the value of owning the underlying currencies such as Bitcoin or the others is going to keep going at this trajectory. It reminds me a little bit of gold back in 2009, 2010. It went from something like $1,200 to $2,000 an ounce, and when it got to 2000, all you saw were ads about gold. Buy gold, buy gold, buy gold, and that happened to be the peak, and it went all the way back down to 1,200, and I think today it might be 1,700. So, and actually, Bitcoin went from 17,000 to under 4,000 during 2018. So that's a massive drop. Now it's obviously back to 50,000, so it's been a great investment. Just tread lightly. This would be part of the speculative part of your portfolio and shouldn't be the cornerstone. It should be the dessert, not the main course. So 5%, 10% at the very most. The other thing I'll say about Bitcoin is that if you have your money in the bank and the bank gets robbed, it's FDIC insured. There's government insurance and you're going to be okay on that money. Bitcoin doesn't have that. If someone hacks your Bitcoin, it's gone. And I do believe there's the Federal Reserve and other government agencies are going to be regulating it a little bit more and possibly make it safer and easier to use. But for now, I would certainly treat it as the speculative part of your portfolio. And I'll draw another comparison to gold. Most of you or some of you may know how the San Francisco 49ers football team got their name. Well, there was a gold rush in California in 1849. And there were a few prospectors that struck it rich. But who really got rich were the suppliers to the prospectors, the ones that supplied the pickaxes, the shovels, the pans, or whatever they're called. And so I would say that I would personally be more comfortable investing in the companies that benefit from the use of Bitcoin or the use of blockchain technology, whether it's a PayPal that charges a little transaction every time you buy or sell Bitcoin. Even Amazon, MasterCard, DocuSign have all have plans to reduce their costs by using blockchain technology. So you don't necessarily have to invest in Bitcoin to make money due to the blockchain technology becoming more and more popular. So that's what I'll say about Bitcoin. Okay, so the third question on this video, are interest rates and inflation headed higher? I believe yes. We've actually started to see that this year. We've really benefited the last few years from very low interest rates and very low inflation. And inflation has been low, partly due to a spending slowdown during COVID that started a year ago, but then also our technology has been so good that companies are doing more with less, and robots and computers are doing a lot more of their work for them, so they're actually able to keep costs either lower or certainly from rising. But now that the economy is starting to reopen and people are out doing stuff, which is a good thing, we are starting to see some inflation. In fact, one of my clients that's a contractor texted me, I think it was just yesterday, and said that the price of lumber has doubled since December. And so he's noticing it. There's still a housing boom going on. So part of that's good, but I would brace yourself for a little bit higher prices. We've been really spoiled the last 5 years or so, whether it's been energy prices, gas prices, or everything else has been relatively in check. So we're probably due for a little bit of inflation. If you haven't refinanced your mortgage, you may not have much time because interest rates are starting to go back up and they've been at record lows for the last year or so. So look into that for sure. From an investment perspective, inflation and higher interest rates probably hurt bonds more than they hurt stocks. So I'm keeping my bond maturities very short. As interest rates rise, those bonds have a chance to mature quick and invest in higher rate coupons as opposed to be locked in at very low rates for a long time. And with inflation, Walmart and Procter & Gamble, they can raise their prices. And so stocks are actually a good hedge against rising inflation because they can pass on those costs, at least to some extent, to the consumer. Okay, this next question. What is all the hype around GameStop and Robinhood and all of this buzz going around? And I think it's very worthwhile to address this and really define the difference between investing and speculating. The latter of which I don't practice with clients. I'm considered a fiduciary over my clients' accounts. I can't be gambling with their money. However, the same way that you buy a S&P 500 index fund or a blue chip stock like JP Morgan or Procter & Gamble, that same broker, whether it's Charles Schwab or whether it's Robinhood, you can buy shares of a startup firm, a penny stock, and you can get pretty crazy and you can borrow to do it. And there's been, I think, a lot of younger investors, and maybe it's because they've had more time staying at home, particularly last year, they started using apps such as Robinhood. And these apps make it very easy to invest and basically free to invest. However, it sort of reminds me of the hypothetical story of a bomb threat downtown. The city noticed a very peculiar package. They thought it was a bomb. They called the very best bomb diffuser in the nation to come and look at it. This guy has decades of experience. He has a perfect track record. I mean, he's alive, right? So he comes in immediately, looks at this bomb for about 5 minutes, takes out his wire clippers, cuts one wire, diffuses the bomb. He proceeds to send the city a bill for $5,000. And the city said, wait a minute, that took you 5 minutes. I'm not going to pay you $5,000 for 5 minutes worth of time. To which the bomb diffuser replied, you're not paying me for the 5 minutes. You're paying me to know which wire to cut. So just because investing is easy and it's free does not mean the risks aren't still there. So there was actually a young investor, I think he was in college still, that was using Robinhood, and he got carried away with it and started borrowing using what's called margin or loan money to buy more stocks. And it ended up falling apart on him, and he actually committed suicide over it. And his parents found evidence that he attempted to contact Robinhood customer service a number of times. They don't have a customer service number. You just have to send an email and hope you get an answer. And he didn't know what he was doing. He couldn't get help. He owed him a bunch of money, or at least he thought he did. And the ending was obviously really sad. So I do worry about the ease of investing making, I guess, causing investors to speculate and not sort of invest in good stuff. So I'm all for making it easy to invest and reducing costs and all that. That's great benefit. But I worry that some of these things could get carried away. So with respect to GameStop, what happened there, now GameStop, if you don't know, basically is a store of retail chains, usually in shopping malls or strip centers, that sell or rent video games. And that model is akin to Blockbuster Video was 20 years ago. And as we all know, Blockbuster went by the wayside because more and more people were streaming videos from Netflix and so forth. Well, GameStop's kind of in that same trajectory. The kids now, or the gamers now, are downloading them from the cloud and using, driving the malls and physically buying games less and less. That said, one of the things that's emerged under these group of young investors, they get in chat rooms such as Reddit, and they pump up stocks. They all say, buy this, buy this, buy this. And they basically formed a group, and they all said, let's buy GameStop. Even though it's not much of a company, there were some hedge funds and institutional investors on Wall Street that were actually shorting the stock, meaning that they wanted it to go down because they didn't think it was a very good company. Well, this group of Robin investors decided, let's buy it, we'll pump the price up. The institutional investors that were short the stock are losing and losing and losing more money because the stock's going up. They got to cover their shorts, meaning they actually have to buy back the stock, which means it goes up even more. And it did something crazy, like went from $10 a share to over $300 a share. This isn't investing, folks. This is, it's speculation, and could be defined as price manipulation, which is actually illegal. Now the stock proceeded to crash back down again to under 100. So, you have to be very careful with some of these chat rooms because you see something called pump and dump schemes, where they pump a stock up to get people to buy, they own it, they benefit when everybody buys, and then they sell it and it comes crashing down. So fundamentals matter, knowing what stocks are valued matters, and hopefully this is not the beginning of a trend, because it's not investing. So I stay away from that kind of stuff, and I would recommend that the viewers do also. Okay, lastly, stocks are near all-time highs. Is this a bubble? Is it going to burst? And my clients know that I really hesitate to predict short-term market moves because it's just so much impossible pretty much to do consistently. I will say this, there has been a large increase in these speculative areas of the market. Electric vehicle companies, micro-cap companies, penny stocks. Some of these are great companies, they're just at extreme valuations. Even Tesla, which is an amazing company, is crazy expensive. You could buy Ford, GM, and Toyota for a third of the price that Tesla is worth. So I think I'm convinced there's areas of the stock market that are overvalued and that I would stay away from. However, the more what I call value stocks as opposed to the high-flying growth stocks, whether it's the big blue chips that have reasonable valuations, maybe pay a dividend, have good fundamentals, those aren't undervalued, but I don't believe they're overvalued like that other group. And they're prone to corrections every now and then. We certainly could have one, 10 or 15% wouldn't surprise me because we've had a huge run here over the last year. But owning the big, solid blue chip names, I'm not worried about that correction because I know it's not permanent. I know it's temporary. The speculative stuff, I don't have confidence that if those correct, they're going to come back. In fact, we've seen that just over the last few weeks. Some of the high-flying names and technology names are off quite a bit, whereas the big solid names in other industries are holding up a lot better. Okay, so I got through what I think have been the most common questions that my clients and contacts have asked me lately. I hope that was of value to you. If you have any questions on your own situation, your accounts, your financial plan, feel free to contact me. Thanks for tuning in.